Well, good morning. I'm Jaginder Rana. The topic of the day is surety bond insurance in India. Surety bond insurance in India. Surety bonds are like safety nets for agreements and contracts. They are needed to make sure that people or companies follow through on their promises. So imagine an organization is hiring a contractor to work on a large project. It wants assurance that they will finish the job and do it well. So a surety bond ensures this. The bond pays you to fix the problem if the contractor does not deliver. So they provide peace of mind and financial protection, making sure everyone keeps their word. So surety bond ensures that you do not suffer financial losses. The bond issuer steps in to compensate you. So you are not left with the bill. Surety bond offers cost-effective third-party assurance for contractual obligations without tying up cash collateral as required for a bank guarantee, often a more financially efficient option. So what is surety bond? Surety bonds are legally binding contracts that provide financial protection and assurance by a third party, that is the surety, to ensure that a party fulfills its obligations or commitments commonly used in various industries, including constructions and licensing. There are three parties involved. The first one is obliged or beneficiary. He is the entity, or this is the entity requiring the bond. Usually government entities like NHAI, large corporations issuing contracts for projects mostly, and then principal obliger. Principal or the obliger means the company that is purchasing, they want to ensure performance of a particular risk. And then this surety or the insurer. So the company that is issuing the bond on behalf, the principal, to oblige that the principal can fulfill the contractual task and indemnify the assured amount to beneficiary in case of non-fulfillment. So bonding indemnifies the beneficiary in the event that a contractor fails to fulfill its obligations. So these are the three parties of the contract. Now conditional surety bonds are there because the performance bond, they are called. A conditional surety bond is issued with specific conditions or requirements outlined in the contract. These conditions define what the bonded party must fulfill or achieve for the bond to remain valid. So common in construction contracts, it ensures projects are completed on time, within budget, and according to specifications. So failure to meet the conditions can result in the bond being nullified, and the bond issuer may be required to compensate the obligee. Typically, the obligee specifies the conditions and terms for the bond, and the surety company assesses the risk accordingly. Unconditional surety bonds. These bonds do not require any specific performance conditions and offer comprehensive financial protection. So they are typically used for providing a straightforward guarantee by the surety company. Unlike conditional surety bonds, where meeting a specific contractual condition is must. So types of bonds are available there in the market. Say for example bid bonds. It's an obligation undertaken by a bidder promising that the bidder will, if awarded the contract, furnish the prescribed performance guarantee and enter into a contract agreement within a specified period of time. It provides financial protection to an obligee if the bidder is awarded a contract pursuant to the bid documents but fails to sign the contract and provides any required performance. And then the performance bond is there. It provides assurance that the obligee will be protected if the principal or contractor fails to perform the bonded contract. If the obligee declares the principal or contractor as being in default and terminates the contracts, it can call on the surety to meet the surety's obligations under the bond. As far as policy coverage is concerned, a surety bond covers financial losses incurred if the contractor fails to meet its contractual obligations or comply with the legal requirements, providing protections to the principal, to the party protected by the bond. Then the exclusions are there. Specific events agreed upon in the contract between the creditor and the principal debtor, changes in the principal debtor's liability due to negligent acts or omissions, applicable laws that excuse the principal debtor from performing the contract, any understanding or agreement that releases the principal debtor from their obligations as determined by the surety insurer. So an increase in the principal debtor's obligations through a voluntary new transaction after the bond issuance. As far as premium calculation is concerned, the premium for a surety bond is typically calculated as a percentage of the bond amount, depending on factors like the type of bond, experience of the contractor, the contractor's creditworthiness, project tenure, and the level of the risk involved. Then the tenure, maximum bond tenure is 60 months. 60 months means 5 years. So including contract maintenance period and extensions are based on the contract bond, whichever is lower. As far as claim procedure is concerned, the creditor must provide a written demand to the principal debtor if a contract is terminated due to a default, allowing an opportunity for cure if the contract specifies a cure period. The written demand is sent to the surety insurer with a copy to the principal debtor and must include relevant documentation such as termination notices, payment certificates, and communications between the parties. So the principal debtor is largely obliged to repay the claim amount to the surety insurer according to the indemnity agreement terms. The surety insurer has the discretion to review the demand and assess the extent of the default to determine the amount payable under the bond. Then the surety insurer must give principal debtor another opportunity to pay the claim amount before making a payment, and if the debtor does not pay within 40 days, 14 days, 14 days, the surety insurer pays within 45 calendar days of receiving the necessary documentation. So surety bond bima is developed in response to the government's vision to upscale infrastructure development. The surety bond bima provides an assurance to the project owner in the form of a surety bond that the contractor would complete the project as per the agreed terms and conditions. The product is designed to ensure the contractors for non-performance and financial exposures in case of contractual default. It helps in ensuring that the contractors fulfill their obligations in the projects awarded, thereby providing financial security to the beneficiary by providing project owners with peace of mind on individual projects. So surety bond helps to promote successful and efficient project outcomes. Now the question is, who can buy surety bond bima? A contractor who has been awarded with a contract to execute a project or supply machinery and required to provide security to the beneficiary or the project owners at the bidding and performance stage of contract can obtain this policy. can obtain this policy. So the surety bond plays a crucial role in supporting India's infrastructure development. Insurance Regulatory and Development Authority is serious about this product because insurance surety bonds are financial instruments where insurers act as surety and provide the financial guarantee that the contractor will fulfill its obligations as per the agreed terms. So this surety bond issued by a general insurance company is a three-party contract by which one party, that is the surety, guarantees the performance or obligations of a second party, that is the principal, to a third party, that is the obligee. So the surety is a company that provides the financial guarantee to the obligee, usually a government entity, that the principal business owner will fulfill their obligations. So while the bond is issued by many insurers, it has become popular now because some of the impediments in the way of surety bonds includes lack of equal legal recourse for insurers under the Insolvency and Bankruptcy Code as enjoyed by banks and weak enforceability of agreements between insurers and the bond beneficiaries. So to address these challenges and drive the growth of the surety bond market, a task force has been formed comprising representatives from insurers, banks and reinsurers. So the task force will focus on developing strategies for risk sharing, enhancing collaborations between banks and insurers, and fostering a conducive environment for the growth of surety bond insurance. So the collaboration between bankers and insurers is important because coupled with seamless data sharing, it will be key to taking surety bonds to the next level. So the formation of a task force is critical step forward in ensuring that surety bond becomes a cornerstone of India's infrastructure growth story. Now the question is, this is a product which is not very old, but this is in demand nowadays because surety bonds are like safety nets for agreements and contracts. They are needed to make sure that people or companies follow through on their promises. Imagine an organization is hiring a contractor to work on a large project. It wants assurance that they will finish the job and do it well. So a surety bond ensures this kind of promises. So the bond pays you to fix the problem if the contractor does not deliver. They provide peace of mind and financial protection, making sure everyone keeps their words. So the bond insurer steps in to compensate you, so you are not left with the bill. Insurance companies are providing these bonds because the bonds are legally binding contracts that provide financial protection and assurance by a third party to ensure that a party fulfills its obligations or commitments commonly used in various industries including constructions and licensing. Thank you very much.